Like many others entering the market across the US, you're probably wondering what the is going on with the real estate market. You're seeing headlines and information come from all kinds of sources saying, buy now, wait, there's a bubble. Sellers are going to flood the market. Buyers are going to flood the market. The American dream is dead. Marry the home, date the rate. Is your anxiety building up yet? I want to help you get past all the burning house clickbait on YouTube and develop your own understanding of how real estate got to this point and where it might go in the future. My name is Ben Wiesner. I've been a broker and investor since 2011, and by the time I was 30, I grew and managed a portfolio of 400 units, 50 of which I owned. I spent hundreds of hours studying finance and real estate markets over the years. It's what I geek out on. So I want to save you all that time and catch you up to speed on where the market's at today. So let's geek out and get into it. Real quick on why this is important to you. When you enter the real estate market, whether as a buyer or a seller, you want to be clear on your goals. And being able to see the big picture of the market will help you set those goals confidently. With confidence comes conviction. And when you know what you want, it's harder to be led astray into making a deal that you might regret later on. So let's dive in. When I started putting deals together in 2011, home buyers and sellers were at the wheel. It was the bottom of the fallout from 2008, and sellers were just giving houses away. There was 3 to 5% interest rates and a 30% price reduction from '07. As the years went on, the markets normalized and rates continued to stay low for 12 years. The real estate market was back on a normal trajectory. These two graphs show two important things. The first is how inventory affected the market through all this time. So starting in 2007, we had an increase in this blue line, which is the months of inventory. So however many houses there are on the market, how long it takes to sell those houses. So the months of inventory and supply went way up through '08 to 2012 when it came back down to a normal level. Six month line is considered to be an average market where prices aren't going to be changing much. So once it got below that line, started getting down to 5 months, 4 months, this is when prices came back and started to continue to increase over time. And then obviously in 2020 and 21, the market just kind of tanked as far as inventory goes and prices went way up. And you can see this reflected in the inflation adjusted prices here. So again, '06, '07, we had the highs for the real estate market, and this is taking away inflation. So we're just looking at the raw prices over time. And then when that inventory spiked up, we had it coming down continuously through 2012. And then this is that normal market coming back up. So this is still, you look back into 1990 and this is the top there. So these are both kind of crazy markets already. And this is heading back to that high amount because rates were so low for so long. 3 to 5% is very rare in the history of the past 120 years. So yeah, this is where we ended up right before COVID. Then COVID kicked normal out the window as the world tried to figure out what was going on and where to get TP. At first, deals fell apart because who needs a home when the world's ending? So real estate hit a short standstill. Then as the dust settled and people got their Fauci ouchies, the Fed stimulated with hard cash, cryptos and stocks surged. TikTok taught everybody and their mother how to turn their house into an Airbnb. Large investors needed to find a place to put the Fed's stimulus money. Full employment had people switching jobs to pump up their salaries. Work from home allowed people to move wherever they wanted, and all hell broke loose for buyers. COVID was a virus to us, but a steroid to the real estate market. Listings would sell in just a couple of days with 12 offers and 20% over the list price. The average time it took to sell a home was cut in half, and so you can see it was at 60 to 80, and then it went down to under 40 to 60 and continued that trajectory. The average home price went from $325,000 to $425,000 in under 2 years, which is crazy. People were saying that inventory is getting too low for the population, but this didn't make 100% sense to me. So I did some research and made my own graphs on the St. Louis Fed's website, which is a great place for economic data, and they have graphs for basically everything. I actually thought it was a combination of all those stimulants that I talked about that really kicked COVID off, plus the fact that households were getting smaller. So in good economic times, young adults can move out from their parents' place. People don't have to live together so much. There's less family and friends splitting rents, and more middle-aged adults were staying single and affording their own rents or mortgages. So it just really expanded the amount of households in the US. And that's what this chart shows. This blue line is the households in the US to the home inventory. And this red line is the total population in the US to home inventory. So we're seeing here that around 2017, there was a pop, things kind of changed. And maybe because the economic times were good at that point, a lot of people could afford to move into their own place. So they started to do so. Then COVID hit, and people probably didn't want to be so close to each other. So they kind of spread out. And this came back a little bit, maybe because a lot of those COVID love relationships came together and they moved into a place together. Not really sure, but then this trajectory continued on up until this year, 2024. So then we have this red line, which is the population versus the total number of homes in the US. And you can see how this was at the bottom in '08 because there's so much building going on. Again, it was a boom for the real estate market, so a lot of building was happening. And then through the teens, there wasn't as much building and kind of leveled out back to getting to normal where we were in around 2000. And then again, as home prices went way up, they were pretty high in 2017, 2018, and it was a good deal for builders to start building homes again. So that population to house ratio really took a dip as obviously prices went up even more during COVID and builders started building more. So it's not really a housing shortage as far as population, it's a housing shortage versus the number of households in the US. All of this put a glut of able buyers and investors into the market, and people want an absolute buying frenzy. 50K over ask with no inspection. Sellers are like, no thanks, we have 4 better offers. This is the market that started to make buyers feel like the idea of owning a home was becoming impossible. There was so much money and emotion towards needing to buy a home or investment property that things kind of got out of hand. Even high quality agents who knew the market and put their clients' prosperity over their own commission had to give in with what the market was saying and make their clients happy, putting in these high offers. Appraisers followed suit and changed their perspective on what people are willing to pay for homes. Fast forward to 2023 and 24, and inflation adjusted prices rose up higher than they did in 2008. You can see on this chart, this is inflation adjusted prices, and this is that 2007 high. And then we came back all the way up past that to an index of 110, which just means that even with inflation taken out, home prices are just skyrocketed. At the same time, mortgage rates normalized, reaching over 7%, which, yes, is historically normal. You can see in this chart. Like I said before, that crazy rise was because the rates were under 5% for so long, and you can see that never happened before in this chart. It goes back all the way to, I think, like the 30s, where the last time that happened. Normalized rates is where we're at, and looks like they're heading down towards like 5.5%, but we'll get more into that later. Some of the COVID boom towns have experienced a pullback already from this high in 2023, but most of the markets are continuing their highs right now. So the question on everybody's mind is, will these increased rates ever bring home prices back down to normal? And are we stuck with these high prices, high rates, and ridiculous mortgage payments? So that's how we got where we're at in 2024. And before we get into the 3 possible futures that I see for the market, I want to talk to the buyers real quick. Whether you plan on buying a home now or in the future, or you're a first-time home buyer, a repeat buyer, I recommend you watch my video on my key points to home buying and how to avoid mistakes in the home buying process. It's right here on my YouTube channel. Okay, back to it. The 3 possible futures that I see for the market are that prices will fall due to a recession. Prices will remain flat due to a soft landing in the economy and the real estate market balancing out over time. And the third is the continuation of prices going up due to inflation and continued low inventory. I'm going to get into each one of these, and we're going to start with prices falling due to a recession. We'll start with the jobs market. The government has been overstating the job creation over the past year. The Bureau of Labor Statistics has been consistently overreporting job creation by 818,000 jobs just in the past year. That's the worst revision since '09. And you can see in this chart that this is this year's revision versus previous ones. And again, not as bad as this since '09. So that's, definitely not a good sign. Unemployment is now starting to show signs of recession. The steep rise to 4.3% unemployment that just came in is a pain point for economists. They have been waiting to see this. It has triggered what is considered to be an accurate recession indicator, the SOM rule. Basically what this is a 3-month average that tracks how fast unemployment is changing. The St. Louis Fed even has a chart for it, which gives it some credibility as well. Historically, when the SOM rule reaches 0.5, it means that unemployment is rising at a fast enough rate to trigger further economic trouble and further unemployment, eventually snowballing into a recession. Some think this could even be worse than what's stated, since a number of these jobs that are include part-time work, and it's a shift from full-time to part-time employment. So let's first talk about this chart. You see that in the recessions in the past, the SOM rule, when it's triggered, has done a good job of indicating recessions that have happened all these times. And right now we had that increase to 0.05, which means unemployment's rising up fast. So they think that, again, this could trigger more unemployment and more economic disparity. And what I was talking about for the full and part-time jobs, you can see these are the full-time jobs in orange, and they've been consistently going down throughout the past year, whereas part-time jobs have been kind of picking up the slack and consistently on the uptrend and adding more of them each month. So since the SOM rule is a fundamental indicator and has been fairly accurate at predicting past recessions, it's definitely something that you want to keep an eye on as we go forward. Another accurate indicator is the inverted yield curve. This is the most talked about warning indicator, and it's been on its worst run in 80 years. It compares long-term rates, the 10-year yields, to short-term rates, which are the 2-year yields. Normally, a 10-year yield is higher than a 2-year yield. So if you are giving a loan for 10 years, the yield or the interest rate is going to be higher than if you give a loan for 2 years. Because investors, they do this because they expect more interest for that longer-term risk, indicating that expectations of steady growth and potential inflation are going to be a factor. So they're kind of factoring all that into that higher yield price. An inverted yield curve occurs when the 2-year yield, which is supposed to be lower than the 10, is actually higher than the 10, signaling that investors expect economic trouble in the near term and likely could be some kind of recession. So this deep dip that we've had the past year or two means that there's a lot of expected economic trouble ahead. And as you can see in the past, once this yield curve difference comes back to zero, you can see it was inverted here, came back to zero, then we had recession, inverted here, back to zero, then recession, inverted here, zero, recession. So that's usually when the recession is a short-term distance away, and we're rising back up towards that zero right now. I believe actually we might have just crossed it, or we're right at it as of the time I'm making this video. And yeah, it's not a great indication of where we could be heading. Credit card balances and write-offs are also rising quickly. This chart here shows the charge-offs from banks for credit cards, which when the bank does a charge-off, this means that they deem the amount of money that is owed to them on the credit card uncollectible. So they just know they're not going to get that money. And that has also been rising steeply. So people have been running low on savings, are turning to their credit cards, and now are having a harder time keeping up with those payments and keeping up with their balances, and just letting them go to collections and never paying them. As people lose jobs and are reduced to part-time, the total number of households is also getting smaller. So if the SOM rule is correct and people continue to lose their jobs or go to part-time, the total number of households is also going to get smaller. So we can look back on that chart I showed you earlier. You can see how the total number of households dipped after 2008. Remember, this is the total number of households divided by the number of housing units in the US. And people stopped building houses after 2008. I mean, it wasn't worth it for them because prices were dipping down. So even with that, the number of households also continued to go down because people start moving in with each other and sharing the burden of rent or mortgage payment. I'm already seeing this happen in the 50 units that I own. I see a lot of people paying with credit cards and building up their debt that way. And hopefully they'll be able to keep paying them and keep renting. And also I'm seeing new applications for people wanting to move in. People are moving in with friends and family. So that total number of households is getting smaller again. So if we get another dip in this could also be another trigger to bring down home prices, since there's less households filling up all the inventory that we do have. And like I said, population to inventory level is low. So yeah, that can definitely change pretty quickly. Another thing that can bring more inventory into the market are the Airbnb investments that are starting to unravel. In their last earnings report, Airbnb showed that they're losing popularity, mostly to hotels and less travel. And the markets that are popular for these Airbnbs are just oversaturated, and all those unrented homes are going to need to come back on the market as sales. It just depends how long some of these people can hold out and if the demand returns for these homes for them to be rented out. Right now, you can see in this chart that the year-to-date occupancy is down. So this is 2021. Obviously, a lot of people are traveling then and filling up these homes. People still are traveling right now, but if this SOM rule is triggered and people are unemployed, everybody's saving more money, there's going to be less traveling coming through. And there's like also just more saturation in the market as well. So you can see since 2021, things kind of have gone down. So we got 2022 in the pink line, which is higher, 23 in this teal line, and then 24 is this year. So it's doing okay this year, but we're definitely coming to the end of the season, and it's going to be dipping down as we continue. So if there is a recession, people will lose jobs and not be able to afford their homes. Months of supply will go back above that 6-month line in that chart I showed you. So decreasing prices. Inflation adjusted home prices will fall back towards the long-term target zone. So this is actually where we were in the long term before we had those crazy low interest rates. And this is where we are inflation adjusted for home prices. So this could definitely be coming back down somewhere in this area. The Fed will also continue to lower their rates, further lowering mortgage rates and the cost to own. So with mortgage rates going down and the prices coming down, it's going to make it a great time to have cash on the sideline to buy these homes because your cost of owning a home is going to go way down. This is exactly what many buyers are willing to do. This is a survey from Bankrate, and they're asking which of any of the following would you be willing to do to find more affordable housing? And 31% said nothing because they know that prices are just high, cost of ownership is just crazy. So they're willing to wait and just see what happens in the market. You also have this 17% saying that they're willing to take on roommates to live with. And you can see this movement against buying homes in the amount of mortgage applications. So again, we're actually at another low since 08 with this as well. So 14, you can see that after 08, all the way through 2014, 2015 even, mortgage rates for mortgage applications were very low just because people didn't trust the housing market and it took a while for them to get comfortable with it again and start buying more again. So if people continue to hold out like this and the months of inventory of supply that chart I showed you earlier with the 6-month line again, if that just increases 2 months, then we're in a zone where prices are going to start to fall, which could be, a great thing for people that are on the sidelines waiting. Not so great for the economy though. Now we have that second scenario where home prices could possibly stay flat. We could just be going through a soft landing. Despite a few nasty months of layoffs, we haven't seen anything terrible compared to the past. I know in the beginning of this year and last year, people were worried about layoffs going crazy, but we had 2 little spikes and everything has been pretty normal since then, actually a little low. So a few of the other data sets that I showed you are still in okay territory and may halt their steep progression. So we kind of watch where those indicators are gonna keep going to. GDP is also expected to be 3% this year, which is above average. See, we have that 3%, so doing okay there. The Fed cutting their rates will have a lot of buyers coming out of the woodwork, but also a lot of sellers will be too. A lot of these sellers are kind of locked into the homes they're in right now because they don't want to go from a 3% interest rate to a 7% interest rate. And now that's coming down. I think we're at like 6 right now. So as that keeps coming down, those sellers are going to also put their homes on the market and want to get into their next home that they've been waiting to move to. Going back to the number of households again, if that normalizes, we might see prices also come down as whatever inflation or anything else that's happening continues to steadily improve the market. So that might be kind of a meeting and a balancing in the middle as well. So instead of seeing a correction, prices may just stay relatively flat as inflation and wages slowly catch up to normalize the market. Okay, so now we get to the third possibility, which is a continued increase in home prices. In this case, we see what the famous economist Paul Volcker was worried about in the 70s. So say that economy slows and the Fed starts to print a bunch of money to save it and keep up with their interest payments. Back when Paul Volcker in the 80s, 70s, 80s was able to shoot up interest rates really high from like 13 to 18% for mortgage rates, which is crazy. They were able to combat inflation by doing that. However, today the Fed can't keep interest rates high because they need to lower it to save the economy and reduce their interest rate payments on their national debt. Because if they don't reduce these debt payments that they have, they're going to go into default, and that would be just catastrophic for the US dollar. So they're not going to let that happen. Looking at this chart, we have the total public debt, which is the government debt, compared to GDP. And GDP is the gross domestic output. So it's basically all that we create in our economy in a given year within our country. And you can see how in the 90s we were at a high point, which they probably thought was scary, at 65, 70%. And then we had the '08 bailout, which shot it up and then kept going up to COVID when they had that COVID relief, and it shot up again. And then luckily GDP also went up. So it kind of brought back this number a bit to something a little bit better, but it's still over 120% debt to GDP, which is a scary number and something that's hard for the government to continue to be able to make payments on, especially with interest rates up at 7, where they're at right now. Well, I guess 5% for their government debt, but it's a scary number, and it's dangerously close to getting out of control for the government to continue to make payments and not continue to add to that and just kind of spiral into some crazy debt situation. So having both money printing and low interest rates to save our interest payments on our huge national debt. So having those two things will leave inflation unchecked and give us a second large push in inflation. So in this case, real estate prices would shoot up again along with inflation. And one thing that I think is safe to say is that this isn't Canada. Canada has seen an unbelievable increase in home prices over the past 10 years. And some are wondering if US could go the same route. I don't think we have to worry about this because Canadians have a different problem than we have here in the US. Their laws have been making it hard for developers to build. So when they buy lands, the government has this crazy process for them to get approved to actually start building. So if you are a developer and you buy land and you have to wait for 2 years before you can actually start building, that's really going to deter people from wanting to build anything. It's creating a shortage of inventory for them compared to their population, which is something that, as I showed you before, the US doesn't have a problem with. If we look at this chart real quick, you'll see how, again, this is inflation adjusted prices. So the US had this bump in '08, now we're at this bump now. But Canada has just went berserk for years, and now it's finally starting to come back down. We'll see if it progresses again like it did last time, but yeah, they have a crazy situation up there. In my opinion, some level of recession seems likely. There's a lot of indicators that are building momentum towards a recession. They could stop in this current Goldilocks zone and just not be a problem anymore. But there are so many of them happening at once that I think they're just building on each other and are more likely that they continue to get worse over the coming year. No one has a crystal ball to see how the Fed, the US, and the world economy will react to all this. So we'll just have to see how it plays out. In normal circumstances, the Fed would soften the blow and lower interest rates as the economy slipped into a recession and hold off on printing too much money because they don't want to bring back inflation again. But today, a recession would lower tax revenue and greatly lower the government's ability to pay off their massive debt and their debt payments that they have to pay off each month. So likely what will happen is they'll start printing large amounts of cash again to put more lipstick on this debt pig that we have and bring back inflation again. My prediction over the next few years is that we get a healthy taste of recession, pullback in real estate prices, and then eventually the Fed turns that money printer back on and has interest rates low enough where we're off to the races again with inflation and house prices. So as a single guy in my 30s with a portfolio that I'm pretty content with right now, I'll be staying on the sidelines in hopes that that crazy number for inflation adjusted home prices does come down to a more reasonable level. And I'll be ready to buy at that point. But I won't count on it coming back all the way like it did in '08 or after '08 when it got down to its low in 2012. I'll try to time it so before the Fed does too much damage and brings inflation back, I'll be buying that dip and then hopefully ride up another side of inflation. So how do you put this new knowledge into action? Everyone has different goals when it comes to getting into the market, depending on their relationship and family status, where they want to live, how long they plan on staying in a home, etc., all that kind of stuff. So typically, if you're ready to move on to the next home, whether it's for family reasons or you just want to be somewhere else, you should go for it. No one can say for sure what's going to happen, and you need to live your life the way you want to live it. So I'll give you a few scenarios and tell you how I would handle them if I was in them. For sellers, if you want to sell your current home and move to one of these COVID boom towns, I would probably just first sell the home. If you see that where you're moving to, inventory is rising, that's a good sign that maybe those prices are going to fall there, and you'll just want to maybe rent first and then wait to see what happens in that market. If you're moving back home from a journey to one of the big cities or one of those COVID boom towns, it could be a good time if you bought a home to offload that. Chances are that the crib you bought probably had a steady increase in price and is worth more than what you bought it for. So yeah, you could sell that and go back to your hometown and use that money to put it on a down payment on your new house that is there. If you're looking to downsize, I'd say it's also a great time to do that. As far as the percentage of homes increasing, if you have your high ticket property and it went up 10, 15%, whatever it did, it's going to be better for you to downsize. And if prices do come down 10 or 15% from where they are, that decrease will be smaller than the increase you had on your higher ticket home. If you're going to upsize your home, I would personally wait to see how the dust settles. So sure, you can sell your house at a great price, and say your 400K home went up 25% and it's at a price you want to sell at, but the 800K house that you want to buy could go down 10%, and that would erase all your gains on the previous house. So that's a situation that I would be treading more lightly in and seeing where the market goes. And for buyers, a few scenarios for you guys. Wherever you're buying, take a look at the specific market you're in and learn where it has been and where it appears to be going. Two great resources for this are a market savvy agent who, again, has been in the trenches and seen over the long term how the market has changed in that area. You can find these on homies.pro if you want to find the best in your area. Or you can also check apps like the ReVenture app, which is one I found. The owner of it does a lot of YouTube videos on data in different areas around the US. And he created a website that has collective data that he puts on a map, and you can see everything that's going on in your area or areas around it. So that's a great resource if you want to check that out. It's called reventure.app, and I have a link for that in the description. Again, if you're buying in a COVID boomtown where inventory is still kind of piling up, I would probably rent and wait to see what happens with the market and prices before I locked a place in for myself. If the market you're looking in is still experiencing low inventory and doesn't have crazy price to income ratios, which again, you can see on that ReVenture app that I mentioned before, then you're probably safe to buy because, I mean, you might have some downside risks there, but it's not as great as a lot of other areas. And again, if you are buying a home, I would recommend to check out my 6 keys to buying a home in 2024. It has my essential tips to making the most of your home purchase and getting into a place that you're happy with and don't have buyer's remorse once you move in. In any case, whether you're buying or selling, making a move or waiting it out, the best way you can protect yourself from buyer's remorse is to have a smart agent that is on your side and puts your interests before their own. They're more worried about you having a good investment in your property than getting their commission, and they're willing to work with you until that happens. Our website, homies.pro, only invites the top agents in each area to join and gives you a list that you can choose from during the process. You can check it out to find your A team of lenders and agents and use it to stay organized throughout the entire transaction. First-time users save $500 commission when they connect with their first agent. There's a coupon in the description below to use our free premium features as well. My goal with these videos is to educate people in a way that is simple and allows them to use what they've learned to make good decisions in their buying and selling journeys. I spent days in economic rabbit holes to give you the best take on today's market. If you like the videos, please like and subscribe to them. It means a lot to me, and I will continue to make this kind of content for you. I wish you the best of luck in whatever decisions you make on the path to your dream home. Thanks for watching.